The illustration is just a snapshot in time. All of these things affect the accuracy of an illustration, which is why you should not buy a life insurance policy based solely on the numbers on the page. So, as my mentor has often said, the illustration is not accurate practically before the ink is dry.
Welcome to the Bankless by Design podcast, where we rethink money, ditch the system, and rediscover what it means to truly thrive well. I'm Tricia Miller, mom of 7, financial coach, and founder of ThriveWell. Around here, we believe wealth is more than numbers. It's about freedom, stewardship, and building a legacy that lasts. If you're ready to challenge the norm and take back control of your financial life, you're in the right place.
Welcome to the Bankless by Design podcast. I'm your host, Tricia Miller, and we're going to be continuing today with our Becoming Your Own Banker series, walking through Nelson's book. And today we're going to be looking primarily at dividends as we go through the chapter, Creating Your Own Banking System Through Dividend-Paying Life Insurance. But before we begin, let's remember where we left off. We are creating a banking system using dividend-paying whole life that gets better no matter what. Every night I lay my head on the pillow. The next day, the cash value has increased because I am one day older than I was the day before. And that increase in cash value is guaranteed by contract, as the cash value must equal the death benefit by age 121. No matter what is happening in the big wide world, no matter the economy, no matter the stock market, no matter what, and you can't do anything about it. Is that good or what? Okay, so let's learn some more from Nelson, and we're going to start on page 22 at the very bottom paragraph on the right-hand column, and he says, in designing the life insurance policy, the rate makers have taken into consideration the advice of the actuaries that their assumptions are not set in concrete. They include the interest earnings on the premiums paid by policy owners, the death claims expected during a time frame, and the expected cost of administration. Over a long period of time, the actuaries can be pretty accurate, but from time to time, the results can be better or worse than predicted. There are variations in interest earnings, death claims, and expenses of operations, and these factors affect the dividend scale declared for the coming year. You can safely say that the real results will never exactly match the illustration provided at the beginning of the life of a policy. But once a dividend is declared, its value is guaranteed from that point on. It can never lose value in the future, as can the value of securities. Okay, there's a lot more to unpack here than meets the eye. But the first thing I want you to notice is that Nelson says over a long period of time, the actuaries can be pretty accurate. So life insurance companies necessarily think long range. They must. Just like you will do better in your own financial life if you also think long range. Now, they look out over a period of 70 to 100 years, and they plan very conservatively. Life insurance companies are slow to make moves for this reason. In fact, I was at the home office about a week and a half ago with the company I write with, and I asked some questions to one of the executives about the portal that we use, as sometimes, and not very often, so don't get me wrong here, we get a little glitch in the system. Nothing catastrophic. And the executive quickly reminded me, we don't operate like those Wall Street brokerages or banks that spend a fortune on all the latest bells and whistles, because we know the technology is going to change in 10 years. And we are about the business of being careful with our capital and thinking long range so that we can pay you a dividend. And I said, okay, fair enough. I can appreciate that. I'll do with a few less bells and whistles for the long-term growth of my capital. Let's move on. But speaking of dividends, Nelson also says in this paragraph, there are variations in interest earnings, death claims, and expenses of operations. And these factors affect the dividend scale that is declared for the coming year. Now, right here, Nelson is basically giving us the general formulary for all life insurance companies as they determine their dividends. Premium for the life insurance company is income, and they have to put that premium to work and earn interest on it, and it's going to vary from year to year. Then they have expenses, and those expenses are made up of death claims and the expenses of operations. This includes all the expenses from the administration at the home office, as well as the sales force that is distributing the life insurance contracts to the consumer. So they must be paid as well, just like everybody else is paid for the work that they do. But all of these expenses are also going to vary. So there you have it right there in one sentence. These are the factors that affect the dividends that is declared for the coming year. They have a good idea of what their income and expenses will be. They've been doing this for a very long time. These are companies that have been doing this for more than 100 years, and they have been consistently paying a dividend year in and year out without fail. That's pretty impressive, though. Some years, it might be a smaller dividend, and other years, it might be a larger dividend. But they have been profitable consistently every single year without fail. So these are good business people. They project their income very conservatively. So while they might only project that they're going to make 2% on their money, and then they end up making 4 or 4.5%, well, they do this, they act conservatively because they know that they have to pay these death claims. It's not an if, it's a when. And they're going to project their expenses to be higher than they might be. So when I read this, I thought, you know what? This is just like investing in real estate. If you want to be a successful real estate investor, let's just say you're going to flip a property and fix it up and put it up for sale. Well, when you go into that project, you want to project that the cost of fixing up that property is going to cost you at least 10 to 15% of all of your projections, just as a fudge factor, because you never know what you're going to find behind the walls or under the floor. You just don't know. And then you also look at the other end and say, well, it looks like the market right now is saying I could sell the property for somewhere between this number and this number. Well, to be on the safe side, I'm going to go with the lower number, and I still might subtract another 10 or 15%. And if those numbers work, then I know I've still got a good deal. So essentially, this is what the life insurance company does with excellence. They're going to assume that they're going to spend far more money than they anticipate and that people are going to die younger than they anticipate. They're doing that to protect your money for the long term. Before we move on, there are at least 2 other important points in this paragraph that I don't want you to miss. So he says here, you can safely say that the real results will never exactly match the illustration provided at the beginning of the life of a policy. So oftentimes, when you are looking at purchasing insurance, you're going to be shown an illustration. But you have to understand what it is that you're looking at. A lot of people think that the illustration is illustrating, say, historical numbers or something, but it's actually not. The illustration is just a snapshot in time. So when I show someone an illustration, I print that thing or I put it up on the screen on a Zoom call, that illustration is assuming a current dividend rate for this very year. And it's going to then make that assumption for every single year going forward into the future on that illustration. But the fact of the matter is that the dividend rate is going to go up or go down. And so that's going to change the illustration going into the future. But there's another factor that people also don't consider, and that is your behavior. You see, the illustration makes a lot of assumptions. It assumes that you're going to max fund that premium every single year annually on your anniversary date. From year 1, every single year going forward. But will you? Most likely not. You see, some years you might have to pay monthly instead of annually. Perhaps it's not working for your cash flows to pay annually that year. So we change the mode to monthly. Well, that's going to change how quickly those premium dollars are in that policy growing. Or sometimes you might pay the minimum on the policy that is required to keep the policy from lapsing, but you don't pay the maximum paid up additions until 6 or 8 or 12 months later. All of these things affect the accuracy of an illustration, which is why you should not buy a life insurance policy based solely on the numbers on the page. So the illustration is not accurate practically before the ink is dry. All right. Second point in this paragraph I wanted to make clear, and that is he says, but once a dividend is declared, its value is guaranteed from that point on. It can never lose value in the future, as can the value of securities. So on the illustration, you will have a guaranteed side and a non-guaranteed side with their projection of dividends, of course, at the current dividend rate, but they cannot guarantee a dividend into the future. That is why you have a guaranteed side that does not include the dividend. No one can guarantee profitability in the future. But once a dividend is declared, which is usually done by most life insurance companies at the beginning of the calendar year, you will receive that dividend at the end of your policy year, so at your upcoming next anniversary. And once that dividend is declared, that is a permanent addition to your policy and it cannot go backward. As compared to a share of stock, as Nelson says here, that can go backwards. So you buy a share of a stock and that stock earns a dividend. There are ways in which you can essentially reinvest that dividend back into the stock, perhaps giving you another fractional share of the company stock. But you see, the difference here is that value of that share can still either go higher or it can lose value. It's not guaranteed. So there's a big difference here between a dividend in a whole life policy and a dividend that you might receive elsewhere. And dividends in a whole life policy are very powerful. And we will get into that more. But for now, let's move on. I'm going to try to stay on track. A significant period of lower than expected earnings of interest, or a period of more than expected death claims and or administrative expenses can result in a downer for the company. So in other words, yes, if we have lower interest earnings or we have more expenses, then obviously the company may not be able to pay as good of a dividend. It says, when this happens in a regular corporation, though, it is the function of the stockholders to take up the slack. But in this case, the rate makers are reminded that we don't have any stockholders. So the rate makers are cautioned then by the actuaries that if we calculate that it would require $1 per year for a given plan, don't collect $1. Collect $1.10 instead. This extra 10 cents is the capital that makes the whole system viable. So again, you see, this is them planning conservatively. So I really want to focus here on the dividend and the dividend scale for a minute, because there is a lot of misinformation out there about dividend rates at life insurance companies. So first of all, let's just define what in the world is a dividend. A dividend is classified by the IRS as a return of premium, and he's going to talk about that further on in the text. Or another way of understanding it, rather than just how it's classified, is it is your share of the profitability that the company has experienced in a given year. So when the company experiences a profit, you get to share in that profit because you are a mutual owner. And remember, we talked about ownership in the last episode and the importance of that. But the dividend scale is a proprietary formula, and rightly so. These are not publicly traded companies. You are going into a contract with a private company. And some of these companies publish their dividends and some of them do not. But they all generally follow a formulary, as Nelson basically gave to us up in the paragraph above. The mortality factors, the amount of death claims that they're going to have or project to have, and the expense factors of the administration of the insurance company. All of these three factors. And what is left over is the amount available for a dividend. Now, this is just a very general formulation. Here is what a dividend is not, though. It is not a rate of return that the policy owner will earn, and it cannot be calculated by comparing the premiums paid into the policy to the policy's cash value and dividends. Remember, dividends are not and cannot be guaranteed. So future dividends are not guaranteed, but declared dividends, once they are declared, they are guaranteed. And you should know that the companies that I work with or that Nelson recommends are companies that have paid a dividend for at least 100 plus years consistently every year since their inception. This is what is needed if you're going to put and warehouse your dollars in a life insurance policy. You want to be with a very solid life insurance company. But still, where a lot of confusion comes in is that many life insurance companies advertise and even market their products based on the dividend scale. It is what it is. A lot of games can be played around this. But when the consumer or even the sales folks who can be and are often guilty of using the dividend rates to sell a product, they start comparing one company's dividend rate with another company's dividend rate, as if that is the way to determine which company you want to go with for your life insurance policy. Well, I wanted to read you something right off of the company's information page about dividends that I write with. I'm not going to name names, but let me just read this to you directly off of their website. It says, there is no industry standard for calculating the dividend scale interest rate. I'm just going to say Company X's dividend scale interest rate is net of investment expenses and default costs. Yet another company may show gross numbers in its rate. So if one is basing their rate on a net of expenses and the other one is basing it on gross numbers, can you even compare that? No. It says the dividend scale interest rate is only one factor used in the calculation, and if we don't know the other factors, it's not a very meaningful number for comparing the overall value of a product. A higher dividend scale interest rate declared by a company may not translate into a higher long-term cash value or death benefit. It is possible that a company with a lower declared dividend scale interest rate might have a higher dividend. Okay, so two things here. They might be calculating their dividend rates differently. And then on top of that, it doesn't guarantee that the dividend rate is going to automatically make for a higher dividend. So if you base your decision on just a dividend rate, you're more than likely comparing apples to oranges. And again, that one sentence really sticks out to me. It says, it is not a meaningful number for comparing the overall value of a product. Any number in isolation does not tell the whole story. It just doesn't. Now, another bit of faulty thinking in this area is that the dividend rate advertised, let's say it's 5 or 6%, can just be multiplied by your cash value, and that's the amount of increase that you're going to have that year in the policy after the dividend is paid. But no, that is also not how this works. So consider this for just a moment, because the guarantee in the policy is that the cash values must rise to meet the death benefit at age 121. So if you have a 20-year-old who has an insurance policy and you have a 60-year-old who has an insurance policy, and let's just say they both are paying $10,000 a year in premium, both clients have been guaranteed by the life insurance company that their cash value must rise to equal the death benefit. Well, the 60-year-old has less time in front of them to get that cash value to equal the death benefit by age 121 than the 20-year-old, right? They have less runway. Therefore, a greater amount of increase via the dividend might need to be distributed to the 60-year-old rather than the 20-year-old in order to meet that guarantee. So what I'm getting at is that even among policyholders, the distribution of that dividend may not be the same. The life insurance company is going to strategically deploy their profits to meet their promises. Now, there's even another factor that makes dividend rates incomparable to one another, and that is whether or not a company is a direct recognition or a non-direct recognition company. Let me explain what that means first. Direct recognition means that they're going to recognize an outstanding policy loan when they pay a dividend. So that means that they are likely to lower the dividend rate for someone with an outstanding loan. But a non-direct recognition company is not taking the outstanding loans into account when paying a dividend. And this is important because when you are practicing becoming your own banker and you are borrowing against your life insurance policy quite regularly, you don't really want that company recognizing your outstanding loans and lowering that dividend rate. But nevertheless, either way, the direct recognition company might actually publish a higher dividend at the outset, but the minute you have an outstanding loan, actually pay a lesser dividend in actual practice. So again, this is why you can't look at those rates and really use them as a way to compare companies. Oh, and one more thing. See, there's so many variables here. The dividend rates also change. So you might be looking at it in 1 year and the dividend rate is higher at this company this year, but 2 years from now, they decide they have to actually lower their rate. Maybe they anticipated their interest earnings or something. So now they have to pull back. And the company who was paying a lower rate for a longer period of time now realizes they have the freedom to increase those rates. So they change anyways. And that could totally change the way that illustration that I talked about, how that is just a snapshot in time, looks 40 years in the future. So this doesn't mean that the numbers mean nothing, but having that be the main factor when it is only one factor without all the context doesn't make any sense at all. So the point is, do not make decisions on a policy purchase or a certain company based on the dividend rate alone. Just don't do that. It's not a sound way to make a decision.
Thanks for tuning in to the Bankless by Design podcast, where we're done with the system and we're doing money differently. Be sure to subscribe, share this episode with someone who needs it, and visit us at banklessbydesign.com to learn how you can start living bankless by design.